Morning, guys. It's Harvey Penny here. Thanks very much for jumping up so early in the morning to be on our live webinar today. Today's webinar is 12 strategies for business owners to save $20,000 or more in tax. Ben and I are here. We've got our coffees and we're here ready to serve. Just while we're jumping online, could you do us a favor? This will both test our audio and our technology. But could you please type into the chat or into the comment box, what are you grateful for today? I know when I woke up this morning, I had the most magical sunset you've ever seen in a very long time. It was like the sky was on fire. So that was my gratitude for today. And probably this double shot Ultimo cap is a close second. But if you can type through to the chat box, just so that we know that our broadcast is working okay, then we'll get underway. So today's session is 12 strategies for business owners to legally save $20,000 or more in tax. And these are the strategies that we've been using with our clients for many, many years to save collectively millions of dollars in tax. Now, this isn't about tax evasion. This is about just paying your fair share. And in fact, because we've had such great success over the years, last Thursday, we launched or introduced to the inspiring business community a very special campaign. And that campaign is called the Save $500,000 in Tax campaign. And we are on a mission to help save young families and small business $500,000 by the end of 30th of June. Now, we introduced you to some special families last week for whom the campaign had already started. And even since we kicked off last Thursday by announcing the campaign, we're already up to $6,000 that has been saved. And that was for Katie, who you would have seen on the live stream yesterday. So this morning is about educating all of us business owners on the 12 really cool strategies that we can use to save $20,000 or more in tax prior to 30th of June. Now, it's not going to be me who's presenting this morning because I'm not the guru in this space. It's actually Ben Walker, my business partner and the founder of Inspire CA. Now, when I spoke to him in preparation for this webinar, this is the message he said. He says, I'm a chartered accountant. I only work with business owners who value family as the number one most important thing in life. And so if a young family in business is turning over $200,000 annually, I can usually save them at least $5,000 in tax. And that's typically enough for a decent family holiday each year. And Benny, if I were to put $5,000 back in your hand right now and you were to take your family and the dogs on holiday, where would you be going, bro?
I think I'd head over to Margaret River again.
Nice. Lots of good wines over there. So congratulations for being live in today's webinar and for taking the time out. I know that it takes a big sacrifice to be up at 7:30 in the morning. And I know it's probably not the most compelling thing to be talking about tax this early in the day or to be chatting with accountants, but trust us when I say that this next 25 minutes will change the game for you, because money that otherwise would have gone to the ATO or to the tax office, we can be using to help fuel your family goals. So with that in mind, let's hand over to Ben Walker with the topic 12 strategies for small business owners to legally save $20,000 plus in tax. Thanks, Benny.
Alright.
Nice stream.
Alrighty. Thanks everyone who's joined from the live stream. I've seen Chris Bray and Corinne Wright join. So thanks so much for your time, and also to people who've joined on our webinar as well. As Harvey said, I'm going to share 12 strategies, but I'm going to split them up into 3 different groups. The first one, I'm going to cover off on business structures, and in particular, what sort of the tax implications of each are. The next one, I'm going to cover 10 people or entities that you can actually distribute some profit to, and they pay the tax, you don't. And the third one is I'm going to share a really, really cool strategy of how to pay absolutely no tax on the growth of your asset. So I might get straight into it. Now we've put together this table which shows the business structures that are available to you. And now across the top row, you'll see sole trader, company, or trust. Now, if you run a business, you'll most likely be running in one of those 3 different structures. And I'm going to cover off 3 different elements of each. And down the left-hand side, you've got how much tax does it pay, can it distribute, and also does it protect your assets. Now, I might just cover on the tax first, because this is the huge the huge impact that we're talking about this morning. Now, a sole trader can actually pay up to 47% tax. So that slide should read 47%, which is a massive amount. That's more than any man should pay, in my opinion. And that's backed up at the recent budget breakfast, where pretty much every speaker said we are overtaxed from a individual perspective, so as sole traders. Now, the second one there is companies. Now, if you're a small business, which means you turn over less than $2 million, you pay 28.5 or 28.5% tax, and big business or over 2 million is 30% tax. And trusts. Now, this looks a little bit weird, but trusts actually do not pay tax. They actually distribute money to other entities or people, and then those entities or people pay the tax. Now, we'll run down to that second line there. Can it distribute profits? Sole traders cannot. It's very inflexible for tax purposes, and we cannot share income, which I'll go into a little bit more detail in the second part of this live stream webinar. Companies have a small ability to distribute profits, and they do that through dividends. There's a few things we've got to watch there, including timing of dividends. So it's not as flexible as the third column, which is trusts. So yes, they can distribute profits. They can distribute money from anything they earn throughout the year. And the last one there, does each of these structures protect your assets? Sole traders do not. You're living dangerously if you are a sole trader, and we would never recommend you trade as a sole trader in business. Companies and trusts do have the same asset protection. So that's that. Section 1 done. Now, on to section 2. 10 people or entities your family trust can distribute profits to. Now, this is pretty cool. The first 6 of these are actually family members and people who are related to you. And the last 4 are entities, different entities that can receive the money. Now, I might just say this before I get in there. The cash actually does have to go to them. It's important that happens, and it kind of defeats the purpose of making them pay the tax but not giving them anything. So yeah, I'll say that before I kick off. Now, the first one and most common, we see money being distributed to your spouse. Now, in terms of individual tax rates, roughly the first 18,000 or so of money that you send to an individual is tax-free. It's because of the tax-free threshold. And let's say your spouse isn't working, they're raising the kids, we can give them 18,000 tax-free, and then the tax rates go up from there. So spouse is a really good option. Children. Now, children under 18 can only receive $416 in this financial year of your profits. Now, that's not a lot, but if you've got 15 children, 15 times 416 is a lot of tax saved.
That's an incentive enough to go have more kids.
Capitalize on them. They do cost a lot more than that to
that would cover the nappy bill.
for a month. Actually, I don't know. I can't comment there. Now, the next one here is retired parents.
Speaking of, yours are online right now.
G'day, Mum and Dad. And thank you, because Dad actually just retired in January this calendar year. And similar to your spouse, you can distribute money to your retired parents, and the same situation. If it's up to 18K or so, there's no tax to be paid. Again, you want to have a look at their situation, and they must be self-funded. If they're receiving Centrelink benefits, then it's actually costs them more to distribute and pay the tax on that money than it does if you didn't affect their pension. So they've got to be self-funded. And yeah, so thanks again, Mum and Dad.
Then I've got a question that's come through. What's the limit? Like, how much, or what's the guide as to how much we should be distributing to any of these entities or people?
Yeah. So I might just say there is actually no actual limit, but the limit we sort of aim for is about $80,000, and that's where the tax rates go from around about 34.5% to 39%, and we're better off putting it in other entities, which I'll touch on in the last 4. It's also important to remember the cash needs to go to the people, and also you just need to watch that you don't affect their tax and financial life by doing that sort of thing. So again, it's something we do with care. We don't just fire money everywhere. Yeah, so that's the answer.
Cool.
The in-laws. So similar if you've got retired parents, and you may also have retired in-laws. Now they can also receive a portion of the profit that your family trust earns. And number 6, I think, number 5 we're up to, which is grandparents. Again, very similar to retired parents, retired in-laws. Retired grandparents are another option to distribute money.
Awesome. Do they have to be in Australia?
They do have to be in Australia. So they need to be Australian residents, all of these people, for this to be tax effective. And the final one of the family members we've got is brothers and sisters. So your brother and sister might be raising a child or at university, and are not earning any income or very little. Now they can be another opportunity to distribute some money to, and they most likely will pay less tax than you if that's the case.
I've got a friend, a family friend who does this one, bro. Their little brother is studying one of the medical degrees, medical sciences. In our doctors study for like friggin' 10 years of their life. It's incredible. So I am aware that he's there utilising this strategy, which is pretty smart.
Yes, yes. And the only thing we need to watch when people are studying is that we don't go and trigger HEX repayments. Is that,
before they've even finished.
That's right, yeah. So that might cost you a lot more than the tax it saves. But yeah, no, it's a great opportunity.
Sorry, sis, not going to happen this year.
Alrighty, so that's our individuals. Now I'll get on to the entities.
Yay.
So you can actually distribute money to a church or a charity. I've got the thank you book that's written by, you might have seen Thank You Water. Grab a copy as well. It's pay what you want. So check out their website, thankyou.co. In any case, there's a quick little plug. You can distribute money to a church or a charity. Again, the money has to go to them, and that's part of what you can be doing. And if you're already doing it, you can make it from before tax dollars rather than after tax.
And shout out for Hummingbird House, our second favourite charity.
That's it. Who also have a gala dinner coming up in a few weekends' time. There we go.
Is that tax deductible?
Not quite. Alrighty, super fund. Alrighty, so super funds generally, when you distribute money to a super fund, you can get a tax deduction for the money you give them up to a certain amount, and that might be up to 47%. But the super fund pays 15% tax on that money. So there's a pretty decent tax saving by giving some money to your super fund.
Are there any limits?
There are certainly limits, which have been played around in the recent federal budget. Cheers, Malcolm. But right now, those limits are $30,000 if you're 48 years old or less, and $35,000 if you're 49 and over per year. Next one, a second business making a loss. So some of the clients we work with run multiple businesses, and they do that on their recommendation in multiple entities. And the reason for that is if one of them makes a loss or gets sued or something like that, it doesn't bring the other one down. Now, if you've got a profitable business, it can actually distribute money to a business making a loss if that's using a trust. Now, that pretty much uses up any, so you might distribute $20,000 and there's $20,000 losses. There's no tax payable on that because there's no actual net profit.
Yeah. And the live stream you did yesterday when you shared how we saved 6+ K for a client of ours, was that essentially using this strategy?
In a way, yeah. So, so the accountants had submitted the tax return pretty much not using up losses that were available to Katie.
And how does that work? Like, did that accountant just miss it, or is it negligence, or what's going on, bro?
I have no idea. There's 20 ways to lodge a tax return or more, and it just comes down to care and attention that they actually put into it. And there may be a legitimate reason, I just cannot think of one. There you go. So second business making a loss. And almost towards the end, we've got distribute to a company. So right at the start, I mentioned that companies pay either 28.5% or 30% tax. Now that is quite a small amount when you compare it to paying tax at 47%. That's almost 20% tax saved. Now you can actually distribute the money to a company, and we call these corporate beneficiaries or bucket companies. They've got a few different names, but it's basically treating it like a personal bank. You know, you can give them money. Again, cash has to go to their bank account, but you pay tax at a much less rate than you would your full individual tax rate. Well, time for, so how do you get a part of our $500,000 tax saving challenge during our tax planning time this year? It's very easy. We do something that's called a look under the hood. And in short, it's a second opinion on if you're paying too much tax and insight into what your numbers say about the health and profitability of your business. Now, there's 4 things we do in that look under the hood process. The first one is a tax review. So pretty much what we've been talking about this morning so far. We look at if you're paying too much or the right amount of tax. We also give you an instant assessment on your cash flow and profitability of your business. Now that's a real eye-opener for a lot of business owners, and something that we really want every single business owner that we help to have mastery over cash flow and their profit. The third one is structure. So a lot of what we've been talking about in the first part and also the second part using trusts is something that we check up on in every single look under the hood. And we give you some feedback and recommendations if we think that should change. And the fourth one, bookkeeping. So a lot of people leave that and don't do it very regularly, or their bookkeeper's not doing a great job. We just give you some feedback on that to see whether there's anything that can be done better, and we go from there. That look under the hood is 500 plus GST, and there is a guarantee. If we can't find that in tax savings for you, we actually give that back to you.
Awesome. And that's what Katie did.
That's exactly what Katie did.
How much did we find her?
$6,000, I think $132.
Probably one of the smallest nuggets of gold we've found lately, yeah.
That's right, yeah.
Cool.
We've had some big ones, which coming up.
Very cool. So if they want to get access to that, you can either type through the chat box or put in a comment below to say keen, and we'll reach out to you and let you know how to do a look under the hood with Benny Boy. Hopefully you can join the ranks of Katie and the many, many other small business owners who we've found paying more than their fair share. Benny, can you just talk about the bonuses if they do it today as well?
Yeah, so there's a bonus in there. We'd love to give you 2 tickets to come along to our Cash Rich Business Workshop. Now, we're actually running one of those Thursday morning this week and Thursday afternoon next week. So as a bonus to people who are keen for this today, we'll chuck in those tickets for nothing.
Awesome. And what is the Cash Rich Business Workshop?
Cash Rich Business Workshop is when you give us 3 hours of your life and we change yours. So we give you the tools and the knowledge to understand why business owners get stuck in cash flow problems and profitability, and we give you a roadmap to wipe that slate clean and set up things so that you don't run into those problems ever again.
Awesome. Thanks very much. So let's wrap up the webinar then, Benny, with I want to see some more examples of people who save tax for. Morning, Moana.
Yeah, so Moana, late last year, whoops, I'm going to get rid of Google Drive there. Late last year, we saved Moana $34,000 in tax. Now that was through some creative structures and a lot of what we talked about in part 2 in this webinar.
Awesome.
And Ross, g'day Ross. We saved Ross $45,000 in the first year he came to us. It's a huge amount, and that was, again, I'm putting it down to the accountant not having his attention to detail meter tweaked. So you just almost cost the client $45,000. Lucky we were able to do that for Ross.
There's a happy photo of the Cash Rich Business Workshop. Hopefully we'll see you there. If you guys want to do a look under the hood with us this month, just type through keen to the chat or the comments box, and we'll give you that second opinion. So Benny, let's crunch some numbers on the Kanye man.
So we've got a picture of Kanye, and this is our case study for this morning.
He's in a bit of cash flow trouble at the moment, so maybe he should be plugging into this tax planning webinar.
That's it. We'll look whether we can save him some tax or not. So without tax planning, let's say Kanye earns $350,000 in income. So I think it'd be a lot more for Mr. Kanye. But let's say it was 350K in Australia. He would owe 138,000 of that to the ATO. Now, let's go through some of the tax planning strategies we talked about this morning. The first one is we distribute $20,000 to his wife.
That'll pay for her nails.
That will, a few nails. The next one there, we give $10,000 to his parents each and his in-laws each. So 4 times 10 grand is 40K. Now the next one there, distribute $13,000 to grandparents and little brother. Another $4,000 to charity. This one is Hummingbird House. So he's just given 4 grand to them.
That's what Kanye.
That's it. Well done. Another $30,000 to the West Family Super Fund. $11,000 to Skinhead Records, which is a loss-making company. No, it's made a loss this year, unfortunately. And 17 grand to a new company, Def Jam Music Pty Ltd, which pays tax at 28.5%. Now, after tax planning, his 350K profit has turned into $105,992. So Kanye has saved $32,000 just with those tax planning strategies that are open to him.
So it's done, hey?
That's exactly how it's done.
So in the context of us on a mission to save young families $500,000 in tax, and how might that look? How many families might that look like? How much tax per family? What is the typical family for whom we can have the best impact? I want to get as many involved as we can really look after, Benny.
Yeah, cool. Well, when you break down the numbers, $500,000 in tax over 25 families is only $20,000 tax saved per family. We also have a physical capacity to how many people we can work with. So any more than 25, and I'd be doing 24-hour days. So don't particularly think that's healthy. So if you're a young family who runs a small business, you've been running for a couple of years, and you're just not sure of whether your accountant is looking after you from a tax perspective, and you'd love a second opinion, then that's the next step is to go through that look under the hood process, and we'll be able to tell you whether you're paying the right amount of tax and give you peace of mind, or give you a magic number of, in Katie's instance, 6,132, or many others, 36 grand, 45 grand, and those big ones as well. And more often than not, there is some tax to be saved.
Final strategy.
Final strategy, and this is a very, very interesting one. We're going to go back to Kanye. Kanye buys a commercial property using his super fund. And in this example, Kanye is actually called Donald. Donald is a 30-year-old dentist. He's sick and tired of paying a lease for a property he doesn't own. So Donald decides to set up a self-managed super fund. He buys the building for $800,000 in Morningside. He uses 400 grand of the money he had in super, and 400 grand he borrows from the bank. The bank lends that to his self-managed super fund. That can happen. Now, his own company, White Smiles Dental, leases the property, and that covers the interest and principal repayments on the loan. So it's if he was renting from someone else, but he's actually renting from his own super fund. Now, let's say 35 years later, he retires, decides to sell the building, and he gets $5 million for that building he bought 35 years ago for $800,000. Now, that's a gain or increase in value of $4.2 million. Now, normally, you'd pay tax on that gain. Inside of superannuation, though, if you're drawing a pension, if you've retired, your fund goes into pension mode, and that means that there's 0% tax payable on any income or capital gains that fund earns. So inside of super, Donald would pay 0% tax. If he held that in his personal name, outside of super, he could be paying up to $987,000 in tax. And the benefit of that is inside super, you don't have to use your current money. Inside of super, that 400 grand he had at the start, plus the bank's 400 grand, that's money he wouldn't have seen anyway until he was sort of, what would he be, 65 years old. So
That's awesome.
Massive, massive tax saving strategy right there.
So who's this strategy appropriate for? Like what type of businesses?
Yeah, so if you run a business that's bricks and mortar, so things like a dentist, or you have an office or a warehouse, something like that, and you're leasing a property off another person, then that's perfect for you.
Does that work for us?
It certainly can, and it will be.
We should do that.
That's it. That's it. Alrighty. Next one here.
Cool. I'll introduce the slide because we're at the end of our webinar. Thanks heaps for your time, Benny, in walking us through all of these strategies. It's very generous of you to share your insights. On our Facebook page, over the last maybe 20, 30 days, we've been sharing more or less a strategy a day for how business owners can be saving thousands. And we went through the top 12 today. There's tons more in the space of medical expenses and repairs and maintenance, overtime meal allowances, and you'll also get to see and hear some of the stories of the fellow young families in business for whom we're making these radical impacts. So I really encourage you to, if you have the inkling that you might be paying too much in tax, then take up Benny's offer to do a look under the hood, and he'll give you that second opinion. It is $500, and remember that it also comes with the Inspire 500 guarantee, which means that if you can't find you $500 or more, you'll just get it back anyway, and at least you'll know for sure. So with that in mind, Benny, can you please switch over to the chat box as well? Let's just see if there's any questions that are coming through.
Yep.
And same too for our live stream buddies. If you guys have any questions for Ben Walker, Chartered Accountant and founder of Inspire CA, related to paying less in tax prior to the 30th of June, what questions would you like to ask?
And just while you're typing those more through, we've had a question from Greg, and
Hey, Greg.
he said, when you start distributing to parents / in-laws / outlaws, love that,
The outlaws.
don't you need to address estate planning issues with, and he's used the word unpaid present entitlement, so he knows what he's talking about there, and basically money that the trust owes them. And that's why I said at the start of that section, Greg, that the money actually does have to go to them. I'll also say that when you do set up business structures, you do also need a will. You need a will anyway if you're over 18. And usually, I think there's a massive statistic, like half or so of adults in Australia don't have a will. Prince, who's recently passed away, I heard he didn't have a will, and it's a shocking situation in any situation where a family member passes and then there's just this all over the place situation of where the money's supposed to be going and all that sort of thing. So yeah, the money has to flow there, Greg, and also estate planning cannot be overlooked. So estate planning in short is basically making sure your wills and everything is sorted when you pass away. That's for you, your parents, your grandparents, your in-laws, your outlaws.
Very cool. And Benny, I've got a question from Chris, who said, is the $500, which I think he's referring to the look under the hood,
Yep.
Is that also tax deductible?
Yes, it certainly is. That is tax deductible, and you can claim the GST too if you're registered for GST.
Awesome. Well, thanks, Betty. I'm getting a few messages coming through of thanks. I had Sharon Cliff here saying, thanks, guys. Love the Kanye example. I was just looking for anyone who was relevant, just trying to spice up sometimes dry conversation with this which is tax.
That's it. We're a little bit gangster here.
Yeah. Just final personal question for you, bro. Like this $500,000, saving $500,000 tax campaign, like, can we actually do it? Like, we're only 7 weeks away from 30th of June, but it's a big number.
Yeah, absolutely. We're ringing the bell pretty much every day with 10 grand saved here, 5 grand here, 35K. So it is something that's happening pretty much daily here. and we'll be adding to that total over the next month and a half almost.
Awesome. Yeah. What would that mean to you as the founder of Inspire if we could actually pull this bad boy off $500,000?
Not that I've got a personal thing against the ATO or Malcolm or anything like that, and I do not believe in tax evasion. But $500,000 in the pockets of families in Brisbane would mean a lot to me. It fulfills me and it gets me out of bed. The ability to take the stress away from raising kids, raising a young family, and helping them grow their business through tax saved is massive. And that's, yeah, as I said, that's something that means an awesome amount for me.
Awesome, bro. Well, thanks very much for your time this morning, Ben, and sharing your strategies. Thanks very much, all of you out there who have tuned in live, either via the webinar or also via the live stream. How crazy is this? A live stream on a live stream for those who are on Facebook.
That's it.
If you guys want us to conduct a look under the hood on your behalf, just type into the comments below, or feel free to reach out to Ben or Harvey or Jess via Facebook or email, and we'll absolutely look after you guys. Thanks very much and have an awesome Tuesday ahead.
Thank you.
See you later, Benny.
Cheers.